Hey, welcome to the Financial Beast Podcast. I'm your host, your BFFF, best financial friend forever, Eric Miller. And we just did another Between Two Erics with my advisor, Eric Gersch. And the topic we tackled today was taxes. We get a lot of people come April 15th that get the quote unquote surprise. And we want to make sure that you don't have to deal with the tax surprise. And what are the things that you can do to make sure that you don't get that call that says you owe, X amount of dollars. So it's a fun conversation. I think that there's really a lot of good data. I think you'll enjoy that podcast. So as always, please like, share, subscribe, write a review on our podcast. And if you need additional help, if you think that there's something about your financial situation that you're not happy with, definitely go to our website, econologics.com, and set up an intro call. And I'll see you on the next podcast. Bye. All right, welcome back. And we did something different today. I had Gersh come up with a topic. Took him 9 years to figure one out, and we'll see if it's any good.
I'm not the creative one. I admit that. I'm really not.
So why don't you tell everyone what it is that we're going to talk about today?
Taxes.
Okay. What about taxes?
Yeah. So
what's the problem that you're running into and all your other advisors are running into?
Yeah. Well, the short of it is April 15th is tax day. Mm-hmm. This year, next year, the year after, and every year. And every April 15th, I've been doing advising now. I think this was my 7th April 15th. Mm-hmm. Every single one. There's a handful of clients who are scrambling last minute because they have to write a large check.
Okay.
And it's a huge surprise. And after digging down deeper into it time and time and time again with various people, it's really not so much of a surprise. So today I just want to talk about the kind of the basics of taxes. They're, what to expect, what little things you can do to help offset them. I mean, I don't want to be here to talk about crazy advanced things. I just kind of want to go back to the basics because that seems to be what people are struggling with.
Yep, I agree. And it's something that happens like clockwork almost every year.
Yep.
So, all right, well, let's get into it then. So for anyone that owns a business, you got to realize that the practice profits give you a personal tax liability every single year.
Yep.
Because you own the corporation. It's usually an S-Corp of some kind. And then that passes through to the profits pass through to your personal tax return.
Yeah, basically, if you're an S-Corp, an LLC, a sole proprietor, a partnership, if you're a professional corporation, if you're any of those main entity types, mm-hmm. the profit of the business is going to flow onto your personal return where you will pay the tax on it. The only exception is C corporations, but those, for the group of clients that we work with, those are exceedingly rare.
Yes. Okay, so in looking at that, but your W-2, obviously the taxes come out automatically, so you don't have to worry about that tax liability.
Yeah, I mean, our owners have two main ways of getting paid. Their salary / W-2, mm-hmm. and then their owner draws, owner dividends, owner distributions, whatever they want to call them. Those are the two ways to get paid. W-2... Yes. Taxes withheld out of each paycheck automatically. Mm-hmm. W-2 generally is not going to cause a tax problem.
Yeah.
Profits, however, are not taxed. Owner distributions, they're taxed, but no taxes are automatically withheld. Paying the taxes on them falls onto you. Now, mm-hmm. One of the basics of the U.S. tax code is that income is taxed as it's earned. Mm-hmm. Right? It's not taxed I mean, technically speaking, it's not taxed on April 15th. You're supposed to pay the tax on it as you earn it throughout the year. That is why quarterly estimates exist. Your quarterly estimates are there to cover the estimated tax due on the profit that you're making each quarter.
Even though you haven't made that profit necessarily. Well, I guess you have from the previous year.
Yeah, so what they do is they look at your previous year's profit and then they figure out the taxes based on, okay, you made 300 grand. We think this year you're going to make 350 grand of profit. So here's the estimated taxes that you'll have to pay every 90 days on it. So it's based on last year plus expectation of this year.
Okay, great. So it's predictable.
Yes, very.
It's predictable. So if you're not getting something from your accountant that's telling you what your quarterly estimates are going to be, that's a problem, right?
Yeah, I mean, that's about as basic as it gets.
Okay. So let's say that I get my tax bill and I know that I have to $50,000 of quarterlies I have to set aside. Yep. Okay. So what do I do next?
Well, there's 13 weeks in every single quarter. So if I have to pay $50,000 every 13 weeks, that comes out to me having to set aside approximately $38.50 per week.
Okay.
So my advice to clients is make your estimated tax. Number one, have a separate account, right? You have your wealth building account, you have your business checking account, your business savings. You should also have your tax account. Okay. And now, let's say my quarterly estimates are 50 grand, like you said. Now every week I can just do an automatic transfer right from the business checking to the tax account, so that at the end of each quarter, 50,000 is there.
Yes.
That's the easiest way to do it in a perfect world.
Yeah. So, but I think what you had mentioned is that, in our system, we typically have people set up like what we call 4 quote unquote profit accounts. The wealth building, the wealth storage account, which is their owner compensation that goes to them outside of the business, but it's a bill of the business. That is for the creation of multiple income sources. They have a business expansion account where 3 to 5% of business revenues go. They have a business savings account where 3 to 5% of revenues go. And then they have a tax account that, I guess when you add up the percentages, what does it usually end up being a year? I think from what I've seen, it's usually about 3 or 5% of revenues.
Yeah, that's probably pretty fair. I mean, it's going to vary quite a bit based on your margins, but I think that's probably pretty fair.
Yeah. So you have to put these things in as requirements. Otherwise, because that obviously puts the correct demand of income on the business. And if you don't, then what ends up happening, I mean, let's say at the end of the year, when someone says I have to pay $300,000 or I have to pay $100,000 of taxes because it said I made $300,000 of profit, but I don't have $300,000 sitting in my business checking account.
No, you don't, because your profit is, it consists of multiple things, right? Your profit consists of, number one, let's say 300,000 is your profit. Okay. What did you draw out? Because all owner draws are you taking a portion of the profit randomly throughout the year. So owner draws, savings, if you're following our plan and you're doing your wealth building account, that's part of your profit.
Yep.
Your tax payments are part of your profit. Your debt payments are part of your profit. Debt is not a deductible expense generally. It's paid out of profits.
Yeah.
And then lastly, money that's just sitting in a business checking account, your working capital. You're taxed on it whether you pull it out as a draw or not.
Yeah.
So just because you made $300,000 of profit doesn't mean you had $300,000 of spendable money go through your personal checking account where you could use it for vacations and groceries.
That's correct. So I think that's why a lot of owners will then just, when they get their tax bill, they'll just usually write a check from the business.
Yep, exactly.
Yeah. To be able to handle that. And that, sometimes they look at their business accounts and are like, oh my God, I had to, eat up all my money to go to my taxes. But I think if the easier thing would have been just to set up a separate account for where that money is going to go. That does two things. Number one, it assigns a purpose to money. And that way, the purpose is there. I have to make money in the business to cover my personal tax liability. It's a bill.
Yeah, it is.
You have to make it a bill. You have to make it a bill. And then the second thing is that it separates the money out so that it's not just like in this lump sum of your business checking account where money just tends to evaporate and get spent at some point in time.
And I think it's important to mention when we say this, like if you're an owner and your profit goes from 100,000 a year to 600,000 in the span of 365 days, even if you follow your quarterlies to a T and save for taxes, you're going to get hit with a big check that's due because your quarterlies were based on you making 100K and you made 6 times that. But most practice owners, year to year, their income is somewhat stable. That's a pretty rare situation for a jump that large. It certainly happens, but it's generally, I would say, within 10%. So yeah.
Well, I think a good growth rate for most practices, if they're doing, an average of maybe 10% growth a year, that's like 30% on a 3-year rolling period or something like that, a little bit more. That's pretty good.
Oh yeah.
That's pretty good. So a 10% growth in receipts, if I'm doing a million, okay, and I'm at a 20% profit margin, that's 200,000 on a million, right? So then let's say that I do 1.1 million. What's 1.
Now you're at 220 of profit.
You're at 220 of profit. So I'm going to have an additional amount that I have to set aside for taxes on that additional 20,000. So it's not ginormous, but you do have to account for it.
Exactly.
And so what happens during this is where I'm like, how often are people talking with their CPAs and letting them know, or vice versa, what their margins are as the year progresses?
They're not generally. I mean, most CPAs are just doing taxes and telling you what you owe, telling you what your quarterlies are for the next year. But there's not a lot of clients who are meeting with their CPAs quarterly, say. It's much rarer than it should be.
Okay. So I think that's the first thing that people need to do is to make sure that they have a meeting with their CPA quarterly. Yep. Come prepared with all of your P&Ls and everything else that you have going on, and meet with your CPA on a quarterly basis.
Yep.
That way they can kind of track, hey, this is what the estimates were. This is where you're at right now. We may need to either shave back or increase the amount of money that you're putting in your tax account. Yep. Yeah. I think it's just that simple to do that. And then that way, when we hit the end of the year, you should know, almost, down to the penny of like, okay, here's what my tax liability is likely going to be in April.
Yeah. Cause if you're meeting with your accountant quarterly, even if your profit goes up a bunch or down a bunch, your accountant can tell you, okay, hey, you need to pay an extra, or hey, you can skip or reduce this quarter. Mm-hmm. So yeah, I mean, it just comes down to the communication and the frequency of it.
Yeah. And by doing that, I think you can also incorporate some tax planning, because if they see, okay, I'm setting aside this much money in taxes, maybe, but I have a build out that I'm going to do, or there's a piece of equipment that I want to do, or I want to acquire, a building or another location.
Yeah. Oh, certainly.
They can give you some projections on, like, okay, this is how this is going to affect your tax liability.
Yeah,
By doing
absolutely.
that.
Absolutely.
So of those, like, typically, what do you get the biggest deduction on? Do you usually get, like, if I'm doing let's say a build out, do I get that depreciation expense 100% in that year that you do it? Or is that spread out over a period of time now?
It's spread out to some degree, but a lot of it is upfront.
Okay.
Yeah, that's a build out's probably going to get you your biggest bang for the buck on dollar for dollar. Equipment's also, you can section 179, depreciate the whole thing at once. That's pretty good bang for your buck. And then just basic things, even like filling up your 401k or simple IRA. That's dollar for dollar reduction right there.
Yeah.
So
what else?
Home office. This is becoming a more frequent one. If you
talk to me about that, because most people will say that my CPA says that I can't do that.
Yeah, I mean, pre-2020, pre-COVID, home office was, I guess, kind of looked at as a dirty deduction, something that people kind of fabricate, if you will. But
yeah, I get it.
Nowadays, having a home office and working from home is
pretty
standard. Yeah, I mean, shoot.
Do you know the calculation on that, or like what? Tell me about it.
Yeah, so the calculation is basically it's pretty simple math. So let's say your house is 1,000 square feet. I know that's pretty small, but just for example's sake. And let's say your office is 200 square feet. So your office makes up 1/5 of the house, 20%. I can now deduct 20% of utilities, electric, internet, right? I can now deduct 20% of my mortgage interest, keyword interest, not your principal payment. I wish. I can now deduct 20% of repairs and maintenance. So, the important part of the home office deduction is it has to be a legitimate office, right? If you just have a computer in the guest bedroom, that is not a home office. If you have a desk out in the living room that you work at while you watch your kids, that is not a home office. A home office is defined as a space that's singularly used for business activities, and it has to have its own privacy. So basically a door. So like if you have, a 4-bedroom house and one bedroom doesn't have a bed in it, it has a desk, it's where you work, it's nothing else is done in there, that's a home office.
I got it. Okay. And for that, you get a percentage of the expenses of the home. So where does that offset? So let's say 20% of, let's say it was, I don't know, let's say it was $10,000 that I was able to take in home office deduction. What's that get applied to?
That's going to reduce your taxable income by $10,000.
Okay. So it's right against your taxable income. So it's a dollar for dollar on your taxable income then. Okay. That's pretty good.
Yeah. Yeah. And like I said, it's becoming more common. I haven't been hearing red flag when I tell clients to talk to their CPAs about it. I think it's just kind of becoming more of an expectation, quite frankly.
Okay. I'm I'm going to ask you about another, I don't know even if it's a controversial thing, but it's something that people will kind of go back and forth on. When should I file? Should I file on April 15th? Should I file in October? Is there a benefit to either one of them? Because you hear that all the time. People say, "Oh, I don't file until October."
Yeah.
So
it doesn't matter. I mean, look, at the end of the day, whether I file on April 15th each year or October 15th, either way, it's 12 months in between my taxes. I'm only gaining extra time that first time that I delay. Now, if I had to pick one, though, I would say April 15th. Why? Because it closes out last year and lets you focus on this year sooner. So what I mean by that is if I'm not filing my taxes till October,
you're already
my
behind
quarterly estimates are not. I mean, yeah, my accountant can still give me estimates to pay in, but they're not based upon last year's finalized numbers. So they're not going to be as accurate. So taxes should be done on time. Now, there are legitimate reasons for them not to be. I mean, sometimes people are waiting on K-1s for partnerships and they don't come till after April 15th. In a case like that, there's nothing that you can do. But if you're delaying each year just because you're busy, you don't want to get the data together, that's just shooting yourself in the foot, in my opinion.
Yeah, because now it's all of a sudden, I can see where people start getting behind on their tax liability.
Yeah,
at the point. And have you dealt much with people having to negotiate with the IRS on past taxes at this point?
No. Okay. I've had one experience with that. It wasn't that attractive.
Yeah, I get it.
The IRS is, and that's actually a good point to bring up. Your question made me think of it, is if you end up behind on taxes, the worst thing that you can do is ignore the IRS. The IRS is not, they're not as evil as they seem. I mean, everyone has their opinion on taxes themselves. I'm not saying taxes are good and we should raise taxes. But all I'm saying is that the IRS will work with you if you call them. They will let you set up a payment plan that is $200 a week for the next 20 years. They're very workable. So just don't ignore it, is what I'm saying.
Yeah, I get that. I
see you chomping at the bit. You're just like,
yeah, I don't think that they're that benevolent, as you say. And it's just the amount of interest too and penalties.
Oh yeah, it's going to cost you to pay them over a long period of time. Absolutely.
And you look at that, and who gets to decide those amounts? Who gets to decide the penalty? And if we really don't like what you did, then we're going to give you an extra penalty on top of that, or some kind of I mean, just the penalties. I just think are. I'm sure there's a term in the Constitution where you can't. I forgot exactly the term, but you just can't arbitrarily come up with these expenses and fees on over top of that and think that they're reasonable.
I'm going to tell you, all you need to do is declare yourself a sovereign citizen. You never have to pay taxes.
Really? Have you done that before?
I am joking.
Yes. Yeah, that's probably not going to be a good idea.
It's not going to work.
Yeah. I'm sure people are chomping at the bit to go down that rabbit hole of whether or not, they are, you could do something like that. I'm sure people have tried to do things like that.
It's gone through the courts numerous times. Taxes are not optional.
Yeah. And people are, they're definitely not voluntary. I don't care what they say.
There's always somebody who thinks that they're smarter than everyone else who's ever lived. And they've figured out the one way they don't have to pay taxes.
Yeah. What are some other tax things that people do that just drive us crazy? I'm trying to think of some other things that people do.
Let's see.
Well, having if you have to take loans out to pay your taxes, that's a bad sign.
Of course.
And what else? I'm trying to think of some other relatively common themes that we see with people when it comes to taxes. Well, maybe we hit all of them at this point.
I think we kind of hit them all. I really can't think of anything.
Yeah. I think the biggest thing is that you have to plan. They are predictable. It's something that we know that we're going to have to pay every single quarter and every single year. There is you have to communicate with your team. And then the game at that point in time is like, once you know how much you're going to set aside, that puts the demand of how much income you need to make on the practice. Yep. You can work with your accountants from there to whittle that number down.
Of course.
What's the game now of how do we get this effective tax rate from, 32% down to 24% or something like that. And you can start looking at deductions. There are a number of deductions that people can take.
Oh yeah.
That a lot of them don't. I don't see a lot of people contributing to HSA accounts. I don't see a lot of people taking home office deductions, just like you said.
Having meetings, having company meetings at their house.
I don't see people having company
putting
meetings
their
at their
kids
house.
on payroll. I mean,
there are a number of them. And there are some advanced tax strategies out there. We've looked at them. We've seen them. There are a number of, charitable donation. I'm going to call them a scheme, not in a negative way, but they're charitable donation, strategies out there that we've seen. Some are legitimate. Some aren't. But those are certainly available out there as well. There's real estate, which gives you, some kind of a benefit in some cases. We've kind of looked at a lot of them before.
Oh yeah.
And it's, you can utilize the tax code, but I guess the bottom line is that you have to be proactive.
Yep.
You can't sit around and just assume that you're going to minimize your tax liability all by itself.
No, minimizing taxes is going to take work. It's going to take time. It's going to take attention on your finances and your expenses, but it's doable. Yeah.
And all those things that we just mentioned, all those deductions that we had just mentioned, it can save you an extra $20,000, $30,000, $40,000 in tax liability.
Oh yeah.
Easily.
Yeah.
Every single year.
I always tell clients, little things add up. Most tax planning is, for the vast majority of people, tax planning is not some big, exciting, singular strategy that's going to cut your taxes down greatly. I mean, maybe back in the day there were things, but nowadays tax planning is just stacking small things, 1,000 here, 2,000 to savings there, 4,000 here. It's just stacking all of those little things on top of each other to become a worthwhile amount, if you will.
Yep, I agree.
So,
okay, we'll leave it at that. Taxes. Good talk.
Good talk.
All right. We'll see you guys on the next podcast.